Looking at the economic data, inflation has already peaked. Now, we do expect it to move lower throughout 2023 with some volatility and don't expect it to be a perfectly smooth line down. Now, is the Bank of Canada really going to meet its long-term 2% inflation target in 2023? In our view, that's likely not the case. We expect that to be more of a 2024 story. Digging a bit deeper into the inflation data that we've been seeing, employment has been quite robust, both in Canada and in the US. But it's important to remind ourselves that employment generally isn't a leading indicator. And in our view, we do expect employment to soften over the coming 12 months. Even other factors such as the cost of food inflation, that pace of increase in food prices also come off its peak. Although food is more expensive, just that pace of increase has slowed down. When we look at the terminal rate, both in Canada and the US, the Bank of Canada has reiterated that they're currently on pause. At CIBC Asset Management, we feel that the central bank is very much close to the end of their rate hiking cycle. The markets are pricing in perhaps one additional rate hike, but it's important to remember that the bulk of these rate hikes have already taken place and that they're behind us. It's a similar case in the US as well, where they're very much at the end of their rate hike cycle. GICs can play an important role in a client's portfolio when used appropriately. They can be a good short-term investment and replacement for cash if they do provide a premium over savings account. Now, today, a lot of investors have been gravitating towards GICs, even for their long-term investment needs. And that might be a decision that's led by emotions. Allowing recent short-term returns in financial markets to deviate from your long-term investment plans can be detrimental to your end goals. Now, that's why we need to remind our clients of the benefits of holding fixed income, and there are four to consider. One, bonds provide a predictable source of income. As investors in bonds, you have a claim on the coupons, the interest and principal payments that you receive on these bonds. Two, they provide a diversification from equity. And as we all know, most clients are invested in a balanced portfolio. The third is really capital preservation. So in terms of market stress, where there's equity volatility, you might see a significant drawdown in that part of your portfolio. It's good to have an asset class that's liquid and it provides capital preservation. The last point I'd really want to highlight is just the source of liquidity that bonds can be, in particular in a risk-off environment where the risky parts of your portfolio have sold off, they're trading at significantly lower valuation. Your bonds can be used as a source of liquidity to allocate to parts of the market that are trading at much cheaper valuations. Given the move higher in interest rates and widening credit spreads, the overall return potential of fixed income hasn't been this attractive in many years. The overall economic backdrop is quite favorable. One, you have inflation peaking, you have central banks that are close to the end of their rate hiking cycle, and the overall yield that global fixed income is providing is much higher today than what it was a year ago. And one way clients can access the global fixed income market is really to the CIBC fixed income pools. The fixed income pools are available in three different risk and return profile based on your client needs. They are available both in an ETF vehicle and a mutual fund based on your client's preference. The pools are managed both tactically to really taking advantage of short-term opportunities that are available, but also strategically really looking at the long-term investment view.